All right, welcome everyone to another Rocket Dollar webinar. I'm excited to introduce Dan here today from VB Capital. Some of you who have been with Rocket Dollar for a while might remember Dan. As you know, been a former salesperson in the company, still an advisor and investor in the company. He gives us plenty of real estate advice and networking whenever we need it. So if you ever see Dan at an event, please be sure to say hi. He's going to know pretty much everyone there. Dan, why don't you introduce yourself?
Hey, y'all. Dan Kryzanowski here in Austin, Texas. I know some of you know me from the Purple No Taxes t-shirt, aligned with VB Capital since the early days of COVID. Great to be here. And how about we just get right into it here?
Great.
Wonderful.
Yeah, pull up your slides, Dan.
All right, great. Well, folks, as always, a disclosure in big print so we can all see it and finally read it for once. So quick bit about me, as I shared, down here in Austin, Texas, group in Scranton, PA. I know a lot of us on the call are both passive investors, and some of us own properties or have raised money before. So please be known, I've been in your shoes. My first, I considered alt investment was back in 2006. My career probably pretty standard for a lot of the folks over 40, Gen Xers and above on the call. Product of the Northeast, grew up on a trading floor, had the benefit of being with GE Capital. If you recall, GE was actually the best company in the world about 15 years ago, which included managing NPS surveys. So since we're going to talk a little survey results at the beginning, want to throw that in there. Quick fun fact to wake up after lunch here. I am 5/8 Polish, which means I'm 3/8 something else for a barbecue dinner here in Austin. If you folks want to have a little fun and continue on the chat, enter what it is. Brendan and I will have a look at the end and we'll see if you get it right. But, outside of that, what I do want to share is, my family's been here about 100 years. My grandparents' generation, very entrepreneurial. I'd say they'd be very into alts. Probably would even have a solo 401k if you think about it. Whereas my parents were very, as they now call, traditional. 9-to-5 workers, pension, max out your 401k. So, in the spirit of rich dad, poor dad, I've had a little bit of each, and, hopefully we're all moving towards the rich dad mindset these days. All right, so this afternoon, and thanks once again for folks taking the time, or those listening now, we're going to touch on a few things. I like to call it single source diversification, the potential to maybe go with a few sponsors versus many. Next up is going to be in the short-term space. You may call it a short-term, a bridge loan, some call it pref equity. This is pretty popular. Next up is going to be, and I'm going to put this in quotes, new asset classes. Why I mentioned industrial, it's something that we don't see day to day. It's not a house. It's not something like self-storage that we use. It's a little bit different. And then a few acronyms, particularly the DST, the Delaware Statutory Trust that we'll talk on. And a final point to share is, you see towards the bottom, you see a nice box. Once again, going back to my General Electric days, I said, if there's anything, put it in the box, folks on the bottom will read it. So these are my takeaways. I hope you find them insightful. And please, as we're going along, Brendan will be monitoring. Any questions, any thoughts? Let's keep this pretty active, folks, and have a bit of fun. All right, so my good friend Steve Harvey, survey says, so what is this survey from? We at BV had the opportunity to reach out to our 500 plus accredited investors. Some of you I know I spoke to one-on-one, whether in-person coffee, and this probably totals, we'll call it another 500 or so conversations this much in the year. Folks, it's what I love to do with all my time. So with all that said, I feel there was 5 or 6 themes that came out of it with, a nice little surprise on the bottom. The first, as we talked about, less is more. There was some sponsors that maybe deal in a few different asset classes. Maybe you feel warm and fuzzy with. This is something to consider. The newer sort of verticals. I know the natural progression is residential, multi. There's some other asset class out there that folks are wanting to get comfortable with. I call it instant ROI, or a proof of concept, is more of quarterly or even monthly distributions. And then we get the chicken and kind of the, I don't know, call chicken and egg, or one side or the other, short-term investments. Close my eyes, get a great return in a year, get my capital back, think about what to do it again. And then on the flip side of this, of course, and thank you to Deanna from Longview for our great discussion on this, is appreciation. On the other side of the coin is, and particularly with the self-directed account, let's look for a longer term deal. Let's look towards the appreciation side. Had to give a shout out to my friends here with the no taxes, of course.
Yeah. Our original slogan, no taxes, obviously through traditional Roth IRA, many of you are already aware of that, but we'll forgo some of those traditional real estate tax benefits for no capital gains taxes, no taxes in these real estate investments.
Awesome, great clarification. And finally, once again, not as much of a play in the qualified world, but folks are selling their property and you want to defer your taxes going forward. We'll talk a little bit on that. All right, so let's dive in a little bit more. Less is more. Especially post-COVID, I feel a bit more sponsors online. Of course, there's crowdfunding out there. That said, if you're investing in 10 deals at this point, do you want to be talking to 10 sponsors come tax time, or maybe say 2 or 3 with 3 or 4 deals at each? It's just something to consider going forward, particularly as things get busy, and particularly if you have multiple deals with the same sponsors, different platforms, whether it's an IMS, a Juniper Square in the background. Just a few things I think to make it a little easier throughout the year. Next up, I keep it in quotes, calling it new verticals. Obviously, all of us grew up in either a house or an apartment. Many of us probably lived in student housing, hotel. That said, I think what we feel is new is when we either touch something for the first time. Some of us with elderly parents, senior living, I think, is becoming very top of mind, especially with the cost and with the high demand. Flip that around, as an investor, this might be a pretty good player as an owner-operator.
And this is our first webinar where we'll really be talking about some industrial real estate opportunities, and also student housing as well. So we've never covered that in one of our previous videos.
Awesome, that's great. Well, happy to share, and please keep the questions coming in to that respect. All right, I love the photo so much I had to do both. Tom Cruise and I think it's the K-pop band down here from Show Me the Money 13. So listen, guys, it's not instantaneous, but I think there's a warm and fuzzy when you can see a return on your investment, particularly a cash flow investment. For one reason, especially folks that have been in the game, whether on the investor side or sponsor side, we've taken some hits. Everybody's been burned one way or another. The gentleman I'm meeting with tomorrow, him and his wife, if it's over $1,000, they sit down. I appreciate that sensitivity based on their experiences going forward. So once again, what's nice here, particularly for folks that might be a fund or a multi-property portfolio, is particularly with a few of those in the door, you can see how this fund is playing out. Say if you write a check today, wouldn't it be nice to get that first distribution, in October versus 2023?
And I think the anxiety as an alternatives investor, like I did an opportunity I was very excited about, but until that kind of first return comes back to you, it just feels like it's a statement online, and obviously these are, we're not working with TD Ameritrade, Fidelity, and Vanguard. So a lot of this in the alternatives world is relationship based and needing to build consumer confidence, when you get into a deal like this.
Absolutely. No, you're spot on here. All right. So happy New Year, folks. I like this one a lot because, a lot can happen in this year, especially this decade. 2020 with COVID, of course, is the obvious. That said, for one reason or another, the last 2 years could have felt very challenging or intensive for one reason or another. That said, you never want to leave your money on the sideline and then wake up a year or two later, whether it's your checking account, your savings, could be your kids' fund, say a 529, etc. That said, there's a lot of good, I think, short-term bridge opportunities out there.
Yeah, and just so you know, if you're a Rocket Dollar investor, you have a lot of cash in your portfolio. That has been typical. The amount of cash with all the inflation worries, the stock market headache, the amount of cash has been sharply growing in the last 6 months for Rocket Dollar customers. So, that's fine to kind of take a step back, plan, see how you feel both emotionally, not make any rash decisions, but you don't want to be leaving that money in cash for too long. As you think, hey, how am I going to use this retirement cash? How am I going to deploy this so it stays invested and it's not missing out on, stock market gains or real estate gains that are out there?
Yeah, for sure. And, putting some numbers to it, let's say 18 months ago, you're sitting on 100K cash. For example, our Archway fund that we'll talk about in a moment, you'd receive back over $10,000 in distributions at this point. You got to think if that 100K was sitting elsewhere, maybe at 1 basis point or so, you're talking about $100. Now's a good time. Our kids are getting back to school, but we still have 4 more months of interest that you can actually earn in this calendar year.
Yeah.
Awesome. Cool. Love this graph. Appreciation makes me very happy because it's the other side. It's the more longer term. And when I think many great hybrids in this space, a good friend Joel Fine here in town, we talk about how we allocate our buckets of money. What I love about this one is, you might be a little heavy in the cash flow, or maybe you have a certain view on inflation. Let's look for a longer term, kind of the slow money, as they call it, on the development side. And let's just take a stereotypical self-directed account holder, 40 years old, 20 years to go before the early withdrawal penalty. You might want something that perceives to be a bit of a higher IRA because you're not taking the distributions anyway.
Yeah, and so when you're using a Roth IRA, traditional IRA, some real estate investors say like, well, I'm losing 1031s, or I'm losing these write-offs, or like rental income. They're like, well, this sucks. Why would I actually do real estate in IRA? Usually the biggest, dumbstruck moment when it hits an investor is, oh my God, there is no capital gains.
Yeah.
So sometimes retirement investors, they'll do a deal that they liked on their taxable side already because they think it's better than some of the stock opportunities or the risk level. But when people really try and think really strategically, oftentimes they're looking at deals that might be super heavy in capital gains hit. Let's do that one in an IRA instead. If that appreciates a lot, total protection from a traditional IRA, you can take that money out slowly. Not only pay a little bit of tax on that each year at income tax rates, or you can do it in a Roth IRA. And then if you were smart about planning about that Roth ahead of time, you will pay no taxes on that giant capital gain at all.
Yeah, Brendan, I love what you shared. Some of you, I and Henry sat down probably about 4 years ago for a coffee, and I said my strategy was, become the next Peter Thiel. So I've been knocking that out, and a very, very strong majority of my stuff is in Roth. So
yeah, and I've tried to take some risks in my own Roth IRA. Can't say it works out in crypto, but if you have the ability, or you're building up a Roth account, you could either contribute to that $6,000 per year, or you can think about converting some at today's tax rates, doing a Roth conversion. It's a very common, frequently asked question. It might be a little bit brutal on taxes now, but if that allows you to hit, let's say, the minimum investment for a real estate deal, like 25,000 or 50, if you can get into that, then maybe you can see some appreciation in that Roth. Then in a couple of years, you'll have a much bigger Roth to come play and be active in deals.
Dynamite. Great. So one final thoughts on the surveys here. I know many of you did the wise move, whether through your IRA dollars or liquid, to purchase properties, particularly with the liquid funds. Now's a decent time to cash out. That's what folks have been sharing with me. That said, you're probably gonna have a pretty good gain, which means potentially a pretty good tax. So there's different things and technicalities in the exchange world. Trying to put some numbers on the 1031. What's tough is finding the exact match mix. Let's say you have $1 million of exchange. Might be tough to find that $1 million, within a property. Say if you find 700, you still have 300K to boot, meaning you're going to pay taxes. With that, if your goal is to no longer own and operate, but you want to defer, stay on that full $1 million, this is where a DST comes into play. So this was, in a healthy way, surprising, a welcome surprise to hear back from many of our investors, many of my discussions earlier in the year. And I think we have a pretty good solution to this point.
Yeah, and with a 1031, that's not something you'll be doing in a Rocket Dollar account, a traditional Roth IRA. But when we have a webinar, we always want our partners to be sharing what are tax strategies for the taxable side, how can they decrease if hit there, and then getting more money that you're hopefully saving to put into those tax advantage accounts like the IRAs, or pushing money to the 401k.
Awesome. So since we're here, beautiful in Austin, and we have our cowboy behind us,
yes,
feeling good. We got to talk Texas here. So, here's why and by we, I feel a lot, folks, us that live here, particularly the owner operator, why we really like Texas. First, #1 state for business. All I got to say is Google it. There's so many sources out there that not just this year or the year before, but for the last 15 plus years, the manufacturing, the export side. I think it's awesome that we jumped Brazil for the top 10. And, one of my favorite here, both the headline of the article and a quote within it from Forbes is that, the most Fortune 500 companies.
Yeah,
right here in Austin, in Texas.
We've seen a lot of movement to Florida and Texas over the last couple of years, but Samsung, a new giant plant where I live north of Boston, Tesla factory goes on for, feels like a mile and a half when you're driving past it on the east side of Austin. And so some people say like, hey, is Texas tapped out, like California or something like that? No, there's a lot of space in Texas. Frankly, 5 minutes north of my house is some new apartments and then a lot of empty cow fields with a few longhorns.
Yeah, and we still love our cows. We obviously love our Longhorns. Sorry to the Aggies out there, but a little plug since we're here in Austin. But ultimately, you're right. There's still a lot of space in Texas, and the likes of in Austin, I think, we're a bit more okay in tighter quarters. Whereas, as you see in the takeaway box here, I commend Dallas, the DFW Metroplex, for going out and up, almost having a mini metro within. Whether it's wow, I pick it, Addison, I mean, you name it. Denton, etc. These are these great areas growing on the Metroplex. And guess what, folks? There's a lot of space here, and folks don't mind driving, especially when it's more of a peaceful drive, not like an LA or a 995 sort of drive.
Yeah, and when people, Austin, like in the very center core, might be very tapped out as far as the real estate side. What I don't think some people that don't live in Texas understand is you drive 30 minutes or you drive to a smaller town that, frankly, it's growing like crazy. You talk to the Home Depot there, the guy's like, we are heading to this town and the business is exploding. So like the Austin Home Depot might be quiet, but these secondary and third towns right on the outside or in Dallas and Houston might be exploding. San Antonio, etc., are exploding, even if a central Austin is a little bit tapped out. The secret's kind of out there.
Touche. So, hey, folks, why may you like Texas? Folks that don't live here, investors also. And I think we touched on all the points. This is a very business-friendly state. There's a lot of space, the military bases, the ports. And if you really get to it, it's kind of nice not to have personal income tax here. So, and I share this at all levels, whether you're in a pretty big, W-2 job, or you're retiring right now and you're going to start pulling out, whether it's RMDs or otherwise. Trust me, outside of the sunshine, it's really nice, not to have the state tax. All right, so with all that, I know a lot of you folks came here for BV and not me. So here we go. Let's get right to it. So first up, BV Bridgeview, it's synonymous because it's multiple groups and a few partners together with a majority of the team in the same office in Dallas. A lot of you folks that we've met before, I've talked to over 500, probably up to 1,000 sponsors over the last 4 years or so. Really sunk with me kind of, I think, in terms of competency, character, track record, and everybody has a superpower. I claim mine to be checkbook control accounts, whether it's construction development. I think that really makes up kind of the BV team and the spirit of the partners that we work with. From an acquisition side, think of this more as, a value add here. A lot of multifamily mixed use is part of the history. These are going to be a bit shorter. And you'll hear me say this a few times. We're not just pushing product. I think we're opportunistic, but also very smart in our underwriting. And as you've heard, and we'll see a little bit more, we do touch a few different asset classes here. You do see the 2024. You might think, wow, that seems a little bit high. Once again, unique opportunities. For those of us that, first of all, happy 1-year anniversary to our student housing deal.
What college is that near?
So it's TCU and UT Arlington.
Okay.
So for all our folks in the Dallas area, some of your kids may even be staying in one of our complexes. Not to go into deep detail here, but let's just say we're a few years above the pro forma on the rent side. And once again, I think staying in your lane per se has some benefits. Some of us earlier in our career, whether it was on the debt side or otherwise, actually worked on some of these deals and opportunities, and fast forward 10, 20, 30 years, they're coming back around again. So, keeping these healthy relationships, we feel is going to bring, some strongness on the value add side. Otherwise, once again, development, think of this as, say, a triple net industrial property, a top tenant, or more of a traditional sort of development, maybe a bit more of a slower play. Once again, it's a bit longer. We underwrite conservatively. That said, we feel we're going to be pretty wise kind of on the tax side, our cash burn, who the tenant ultimately is with this. So once again, a little bit lower, but I said every deal is going to vary. All right, so, investment strategy. This looks like an investment 101, but I do want to touch on, 2 things. From some of the pre-call conversation that we had before we hit record, I know there was some discussion on the mix of kind of, hey, what's the supposedly lower risk, low return, maybe higher return sort of opportunities. Something like a triple net industrial is definitely, more in the core sort of audience. Whereas think of opportunistic, a workforce housing, or, there's a fair amount of properties where there's just an absent manager.
Yeah.
The place doesn't get Animal House, but, maybe they forget to raise rents. Maybe they forget that they put something on wave once and it waives fees throughout. Happens a lot, happens a lot more than you think. But from there, right off the bat, you're gaining a big bucket of money on day one. And when you think from an NOI perspective, which feeds into your evaluation, this plays out really nicely.
Proper management.
All right, so BV here, investment focus, no surprise. Texas is number one. The Sun Belt states, a lot of the other no tax states, such as Florida. You might say, hey, California, that doesn't seem like a no tax state.
Yeah.
Correct, it's not. But once again, as you look into certain cities, certain MSAs, something like a Sacramento with a one-of-a-kind medical facility, that's a pretty good one, particularly with the AAA credit. So come from our relationship, I said everybody comes to the table with the superpower. Has led to some of these conversations recently.
Yeah. And you obviously, BV has its like bread and butter type state, but you do step out of that when you see the right opportunity, for sure.
Awesome. So, once again, we've touched on multifamily, some mixed use, some industrial. We're going to keep it diversified. And as we're talking medical and office, this is really about, I think, the tenant, strong tenant, strong credit. That we're going to look at going forward. But, the multifamily and industrial, I think, are two really good, verticals at the moment. From a summary perspective, we've gone full circle, about $250 million. You see, kicked it off kind of in the retail space, a lot of multifamily. Since then, heavy both on the triple net side, and then also, once again, on the multifamily. In addition, doesn't show here, but we have current projects in that's really going to almost, potentially double the AUM in short time. So from a sold projects, we're very transparent here. A majority of these are kind of in the 18 to 32 IRR range. A lot of factors that go into this. You see some of our most recent sale at Alpha West, beautiful property here. See a nice photo in the lower right-hand corner. Smack dab in the middle is actually a property here in Austin, a workforce housing, 50 plus IRR. It seems crazy, but people say, it's Austin.
Yeah.
I point out again, this is 2016. So once again, some of the, I'd say BV wisdom is a lot of what we've gained from here. And I think the operation shows the benefit that we had when Austin wasn't, Austin, as they say today. And then fast forward to 2021 or so, post-COVID in the DFW area, we're able to take the lessons learned here and bring it into a new project.
Yeah, and I see a lot of out-of-state investors getting, flustered because maybe they missed the boat in Austin. It's like, well, you got to stop thinking about Austin. You're like, what is the Texas town that was Austin 2014, 2015? What are those names? And, you say that to someone outside the state and, they can maybe Google it, but they're not doing as much due diligence or hearing through the grapevine, like, hey, where is the real estate exploding? Luckily in Texas, you can usually just take a drive down the road and you can see kind of the front line of the expansion here. The density is very different here. It's kind of all or nothing. There's no, it's a farmlands or it's getting built up with multifamily and self-storage. Yeah.
Storage, baby. Great segue here. Obviously we've touched Dallas. A lot of the partners have spent time in their career, schooling, et cetera, in the Houston area. Lower right-hand corner, we talked, I think this Austin, San Antonio metro, there, whether it's New Braunfels or otherwise, there's some great opportunities here. And then when you talk about vertical type in the specialty hospitals. So, over time, expect as we update this chart over time for these to grow. All right. So now we get to the fun stuff, folks, the investment offerings. So currently, and I'm sure some of us have been to the website. We've talked about this. At the moment, 2 projects are opened. First is going to be our income fund, also known as BV Archway. We'll talk about that in a moment. Secondly, as we preface, not as much for the qualified space, but the DST. We feel this is something, especially if you own properties or you're in process, or maybe you sold last week, you really want to get to know that this is an option out there.
That's that. If you're thinking like the 1031 or you're having trouble with that, that's where you should approach Dan and ask about the DST, the Delaware.
For sure. And then, coming soon, and by soon, for folks listening on recording, this might be the present for you, but our short-term land deals internally, we call these a stage one or a land. Once again, still places we're very familiar with: Corpus Christi, the DFW Metroplex. And then, stage one goes into stage two, and these are going to be our development projects or stage two. As you can see, a lot of folks have either vacationed or wanted to vacation in Galveston. We have another suburb, and then once again, New Braunfels, which continues to receive, tremendous accolades throughout. All right, so here we go, folks. BV Archway. So let's just go to the headline. We think back to our survey results. Why would this be of interest? Well, first of all, let's talk about the asset versus the return. Many sources have called this a bond wrapped in real estate.
Okay.
A cash replacement, a bond replacement. And why is that? Is that you have strong credits in mission critical properties for 10+ year long leases. In areas where they have a strong foothold. So,
and these older investors, whether you're if you're in your upper 40s or your 50s, usually those investors have some type of bonds in their portfolio. There's obviously been a ton of frustration in that in the last few years just with interest rates. So that's honestly like one of the main reasons, if it wasn't you, if you're thinking of this subconsciously, when people say, hey, I want to come to Rocket Dollar, I'd like to get into some of these alternatives. Oftentimes what they're thinking, whether they know it or not, is they're looking for something to replace their bonds in their portfolio. Something that has kind of an expected return to risk level that they can judge, but is not quite moving with the stock equity market as much.
Absolutely. And the nice thing here is, I said, you can see there's already 6 properties. There's a 7th that's actually a Fortune 100. The ink's drying on the press release, so we're excited to share that. Kind of a slow and steady sort of raise also, as folks got to know us. This is how they like to enter, kind of from a mutual trust perspective, the world of BV. One thing, probably because of just space here, the distributions also come K1 time or coded return of capital, which, from a net basis, makes it very favorable for your distribution that you can get here. And at the end of the day, you're getting that monthly check. You start accruing on day 1, generally get paid the next month after, and there's still some upside split at the end. So, head to toe, this is really exciting. And, myself personally, hey, February 21, you wrote a check.
Yep.
Guess what? 100K in, I'm looking at over 10,000 at this point.
Great.
Nice, warm and fuzzy. All right, so we call it BV Archway. Who's Archway? Archway is actually one of the top developers on the industrial side here in Texas. They've been around 30, 40 years. I'd suggest taking a look at their website, Bimbo, et cetera. Great properties and notable brands that they've been here. But most of all, I think I'll take you to the takeaway box here, is that you're looking at really strong tenants. Floor and Decor, their market value, has done really well since COVID time. Third-party logistics out in the Houston area. Loomis, you probably see them going to the ATMs. This is like I call it a big Fort Knox in El Paso. Department of Defense certified. So I share all this because many of these tenants have a foothold. They probably put X hundred, 1,000, or even X million of their own money into it, and you're looking at, generally speaking, 10-year plus versus the fund, which we probably have about 3 to 5 years to go.
Yeah, I think you're going to get into this, Dan. But part of some of these tenants that you're targeting is a little bit resistance if we see any COVID stuff pop up. Like a shutdown, that doesn't really happen often in Texas, but keeping those businesses, that security of the business over the next couple of years of that uncertainty.
Yeah, Brendan, you're spot on here. So if we think back to one of our kind of first slides, folks talk about what's new. Obviously, done residential, maybe use self-storage, but you don't really think of industrial until, well, oops, I ordered something from Amazon or the like, and it's the last mile that comes in, or there's something that needs cold storage, maybe something medical, et cetera, for a while, and this comes to play. So, Brendan, you hit the nail on that head here. If we just take a quick look at, say, the 3rd and 4th graphic here, none of these properties that we looked at on the previous slide, or you can look in the PPM, shut down during COVID. They're truly essential. and mission critical. And by mission critical, we mean to the business itself, whether, this is where they make their widgets, entertain their clients, have some sort of warehousing, primarily where their employees and their families live. I joke, it's not like a 2-person startup that's going to pick up from California to Texas to come here. There's a lot of money and otherwise entrenched in these facilities where they are. But on top of that, once again, essential businesses, they tend to be doing pretty well.
Yeah, and a lot of these, whether it's a long-term business or a business moving, to Texas, they're making like a commitment for the next 5, 10, 15, 20 years for these, bigger corporations, long lasting. They're not looking to move to Texas and then move back,
No.
2 years later. That's a big strategic decision that they're taking, and then you're usually selling, old assets that they have where they're leaving.
Good stuff. So listen, guys, I know no fancy pictures on this page, but let me just touch on 2 things. Towards the middle here, you see a few bold-faced bullets. This is a low LTV. We're not going to go with 65. Some properties are sub 60 now, and the debt service is solid. It's a solid 1.5 year. And to point out why I underlined it at the bottom, BV just doesn't push product for sake of. We're not going to enter with Amazon to get their logo at a 3 cap rate like some people did. In short, we're not going to dilute the portfolio. So, shifting and putting on my LP hat, by default, all of us are potential passive investors here. You have to think about, this is a pretty solid portfolio right now that you can enter into. Once again, 18 consecutive months of payouts. Obviously, there's been some really strong appreciation because some of these properties were kind of transacted at pre-COVID prices. I call it pre-2022 debt. So you're getting that benefit on almost, as you said, raised about $24-25 million at this point.
Pre that property explosion, pre-inflation, asset prices flying upwards.
You name it. So, final thing here, once again, as we touched on, what makes it mission critical? A lot of these folks, they've invested their own money into these properties. It's truly a headquarter or a site that's extremely important to their business. So once again, very difficult to relocate. So we feel pretty good. And even with some of the turns, I said Archway has had a relationship with some of these folks for decades now. Knock on wood, rent has never been an issue. So we feel good about that.
Great.
All right, so first I'm going to give once again a light apology to our friends that strictly have a self-directed IRA, and you're going to be an LP and maybe not as familiar with kind of owning and operating. That said, I bet somebody that does, especially as folks are hitting retirement age, feeling they're hit at the peak of a market. As I said, I suggest to become aware of the Delaware Statutory Trust right here. And we're going to talk about a property and also, some of the DST benefits in here. You see it underlined, the 13 to 15 IRR. I know what you think, that's kind of okay. But folks, I'll tell you, in this, I'll get to that on the next slide, in this DST world, that's beyond a home run. That's almost 3x times the benchmark here. So as you're seeing single property DSTs in double digits, and just to point out, you can move the full value of the property you sold into a DST. So
And Dan, I think for the benefit of maybe some of the newer real estate investors, could you explain a little bit the IRR? Like when people go to jump into their first real estate investment, like what do they see? What are they seeing out there in the market? Like what's competitive versus something that an experienced real estate investor might look like? That's bad. I'm not even interested in that.
Yeah, so there's a lot of, you see the MOIC, multiple on invested capital. You're going to see it for newer investors in space. There's a lot of acronyms. What I always suggest, brothers with, qualified money, cash, et cetera, is say, if I gave you $100 today, let's call it, January 1st, how does this look over time? And very roughly speaking, IRR is going to be an annualized return, over the 2, 3, 4, 5 years, how long it's gone for. And that if it is a deal that pays distributions, dividends, that will be included in the IRR.
Okay.
For other ones, think a development project. You might see something, hey, high teens, 2x, which is kind of same as a 2.0 MOIC right here. So, but I would say bring it back to just the cash or the cash on cash. Great question. Great way to go into it. All right, so let's look at this one. what's great here, and this is another, I think, example where beautiful, trust me, we'll look at some photos in a beautiful property, dynamite location, just, didn't get the love maybe that it could have here, or the attention. As you can say, we acquired this property, rents, you're talking like a 25% plus discount. That 159, you're looking at about 190 now, kind of the neighborhood, well over $2 a foot right here. Going to the takeaway box you see at the bottom here, a lot of DSTs return only about, low single digits, mid single digits. There's a lot of fees baked within. It's probably, the Vanguard-ish of the world, a portfolio. So yes, pretty stable, but, we're hardly even touching inflation at this point. Whereas here, and we go back to your great question on the IRR side, we're kind of looking at like a 12 to 15. You can argue almost 3x the benchmark versus some other DSTs out there. So, finally, as you look, and while it might look a little small, the star on the map, this is a short walk to Victory Park, as I also call Mark Cuban's playground here, with the maps and everything else. Uptown SMU is a very short bike ride. The historic, the old school downtown Dallas business districts and such. It's close. And there's a certain factor. People think, hey, Texas, big truck, gonna live outside. A lot of folks are moving, or, at a certain stage of life, they're empty nesters, et cetera. They like the walkability. It's vibrant, particularly in the daytime here. And what you have is, you have the Virgin Hotel, you have some other Class A properties along, and a relatively new property with.
Yeah, they're coming from an East Coast, they might not have owned a car or driven it much in the last 15 years.
Mhm.
Walkability, high rise, similar if they're coming from Chicago, a big city in the Midwest, or downtown, or maybe they're coming from a New York or a California where they're living downtown.
Absolutely. And folks, we'll be sharing in the chat in a moment my contact info. So, just to get to know each other one-on-one, but particularly if you are, I know one gentleman who may be on, his date is August 30th, that he has to decide kind of how he is exchanging from his property, particularly if something is timely. Please let me know. All right. So what's coming up in the very near term? The short-term land investments here. We've also, for those of us who have sat on some of our investor calls before, we might call it a bridge loan, a stage one, a land deal. What's great here, I said, this is a proven strategy, and we fill areas, for example, within the DFW Metroplex that have, on the right here, you see Mansfield, south of Dallas, not a typo, a high number for Texas. Over 125,000 income, 3 to 4% population growth. There's just a lot of good things that are going on here. Strong schools, strong companies. This is a place we like to be. And once again, effectively in our backyard with the folks we're going to be partnering with, the permitting, et cetera. So this is a warm and fuzzy. And I bring this up as an example because this was a phase one that will now be, in a phase two in relatively short time. And the other thing here is, we do respect everybody's time, doing the diligence, looking at deals, going through the investment. What I really like here, and sometimes the fine print is the best thing, and the little asterisk is that in addition to, a 20% annual pref, we have a nominal return. So, let's take 12%. What does this mean? Let's say, you put 100K and we happen to do what we need to do in 3 months. Well, on linear math, 3 months times 20% is going to give you $5,000. As a thank you for, your time, effort, energy, we'll pay out $12,000 in this example. So right. I think there's some really good kind of short-term plays, and especially folks that live in Texas, probably have worked in Dallas before. You kind of have a good gut feel why this is a great location.
Yeah, and we've heard all about Austin the last maybe 2 or 3 years. Dallas has had a much bigger concentration of wealth for a long time than Austin. So a lot of money out there and very spread out, lots of opportunities. It's such a big metroplex.
So we were looking at, coming up in the Corpus Christi area. So this is going to be 300 plus units. There's going to be a piazza. Hey guys, we're going to have some fun with this one, but beautiful piece of land for folks, all my Aggie friends. There's a shout out to you now, or folks that live closer in the Houston area along the coast. And then Denton might be familiar for some of our folks that have been in our investor portal before. We have another property there. Once again, it's really nice when you can step into the same neighborhood and look at another property. So, if interested, please share your information on our website to learn more. And, finally, and I thank everybody for taking a listen and stuff coming through on the chat and Q&A. And feel free to add your questions now. We will get to them shortly. Is development projects. We also call this, the stage 2 right here. This is backed off of, as we just looked at, Mansfield. We see a great graphic of Galveston. Once again, strong population growth, great income, the port, everything else that benefits that will be doing projects. So, what are we looking at here in relative short order? Let's go from right to left on the screen. You see Mansfield, and NB stands for New Braunfels. And what, alone, even if you didn't look at the numbers here, I half joke is that you have the Texas Trinity of Buc-ee's, Whataburger, and H-E-B.
Yes.
So, any good Texan for that reason alone has to live here. But, Mansfield and New Braunfels, booming. New Braunfels is less than 40 minutes or 40 miles between Austin and San Antonio. As the Metroplex grows, as, even San Marcos becomes its own community, New Braunfels even more popular here. Both of these are going to be, 300 to 400 beautiful apartments. We feel good about these. And then,
and Dan, I just want to pause here. If you're listening or if you're on the recording right now, you've done yourself a good service. You've just heard the names Corpus Christi, Denton, Galveston, Mansfield, and New Braunfels. If you didn't really know those locales before you tuned in today, that's valuable to a real estate investor. So BV is kind of already out in the forefront of that. Just know, those are valuable names to remember if you have a conversation with Dan, about these opportunities. There's a reason why those names come up, and some outside Texas investors might not even know opportunities exist there right now.
Yeah, and I mean, listen, folks, I started off as a passive investor. So whether you're in Arizona, I know, Tucson, Phoenix are very hot. I'd love to trade notes and see what you're seeing. What is the equivalent? The benefit of doing my master's at Thunderbird, a lot of friends in Arizona, by some counts, they're still short in the hundreds of thousands of units that need to be developed. So I would love to have a similar sort of conversation here. So finally here, just Galveston, as it looks, this is a beautiful, community on the water. Here, we're actually going to be selling the lots. Just a fun fact, as I said, we always show some love to our investors. Some that invested in stage 1, we'll kind of give them first dibs if they want to buy a particular lot before we go to market or, going forward here. But this is also exciting. I know a lot of folks, even if you went to school in Houston 20, 30 years ago, maybe this is your vacation home. Maybe this is where you, quote unquote, work from home a few days. We're excited about here. We actually picked up an adjacent piece of land, and of course, we'll be open to more in this immediate area.
And I always say to IRA investors, we have some IRA investors that they get really excited, like, oh, I'd love to put this property or this investment in IRA, but I kind of want to live in it later or something. There's always that, like, well, can I figure out a way to do it? And I would say this. If you are excited about an opportunity and you're also excited to live there, keep in mind the prohibited transaction risk. So how do you meet that? Go into the deal that's pretty great for your IRA, but a little bit more boring to you personally. Have a great investment experience there, but you won't be tempted to double dip and potentially have a prohibited transaction risk. So if you see this and say, hey, I actually do like that I get first dibs at that vacation home, invest in Galveston with your personal account. And then with your IRA, go for another deal like the Mansfield or New Braunfels. And, someone was pointing out like, hey, I don't know what Buc-ee's is. That's just a little Texas joke. Probably like the biggest rest stop you've ever seen. Might not be as classy as East Coast stuff, but here in Texas, people love it to do it big and a lot of value coming out of those couple places.
Yeah, and I half joke that Buc-ee's, would probably be the only thing to fit on our 17-acre site. So it really feels that big when you go there to fill up your gas tank. So good stuff. Well, hey, at the finish line, folks, do you want to learn more? Of course you do. Thank you with all sincerity for sticking around here. Just want to note a few things. First, right in the takeaway box here, if you do have a moment, and you'll see this in the chat, if you can visit bvcapitaltx.com/investment-offerings, just a real basic kind of name and email Please reference my name or the Rocket Dollar webinar in there also. Once again, we accept qualified money, self-directed IRA, solo 401k. The checkbook control does come in handy, especially with the fair number of our deals. Once again, exception on the DST. The accredited investor verification. I know a lot of you probably have a CPA, probably already have that letter. We'll go through that. And then, the minimum investment, it varies by opportunity and also the funding source. Pretty aware, you cannot commingle accounts with your personal. And secondly, just, maybe your Roth, I don't want to say only, but, has 60 or 80,000, we're open to that discussion. So, with that, just want to say thank you. I'm pretty active on LinkedIn. You see my LinkedIn. Would love my email, love to have a one-on-one. My HubSpot is there. I think this is also in the chat right now. And
great. And if you are a real estate investor, you're ever looking to network, always hit up Dan, add him on LinkedIn. And we just want to pause for any questions that you might have. If we don't have any questions, I have a super quick retirement topic I can go over just for like 2 minutes. But please, if you do have one, throw that out now. Yeah, but networking in the space, super powerful. Again, like if you don't know Arizona well, a 5-minute conversation with an experienced investor there can show you a whole world that you were ignoring. And any state that you can get an advantage. And, think of them being nice enough to share that with you. That might be a secret they don't want to get out. But if you can think of a nice trade, it certainly does pay off to network like that out. All right. And I know some of you might have seen this before, but for the benefit of the recording and a lot of our clients, they have what's called our IRA LLC or checkbook account. They are not familiar with what a direct custody IRA is. So I'm going to go over that really quickly. We've had a few people excited to refer accounts, and then they're interested to see what is this direct custody IRA. So I'm just going to pull up some of those slides. Feel free to throw out any questions that you have for Dan, and we'll be sure to answer them while I'm pulling that up. All right, Q&A, okay. So someone asked, do you cover, how do fees work for management fees, admin costs, and other expenses that apply to some of these fund opportunities?
Yeah, great question. So a lot of what you're going to see is going to be net of fees. So let me talk about Archway also. A lot of the typical fees that you would see in a fund, say a 2 and 20, acquisition fees, etc. We're not charging any of that. Kind of in the spirit of investor alignment, we're not, the back end is a 50-50. A lot of times industrials may not even have sort of a back end, but we feel comfortable probably looking at like a mid-teen sort of IRR from the fact that we're not going heavy in those sort of fees. And also reading into the question is, you're not going to see kind of what you would see with a financial advisor. We're not charging an AUM from that standpoint. So a lot of things are going to be net. And the final point I would make, our most recent short-term deal was actually in California. And not only did our partners put in, I'd say, the most common equity tranche, meaning us as LPs were in the preferred space. But on top of that, say any sort of California taxes were going to be covered by BV Inc. So you as an investor, we're going to get the number, that you see on the headline.
Great. And Dan, this is always a really common question. I know we mentioned kind of the early payouts, but when it comes to exiting a fund, so these are the two things people think of. When am I first going to get paid? And then if something goes wrong, how can I exit? So can you explain how that works, the liquidity?
Sure, absolutely. So, once again, the nice thing is, let's talk on Archway. You started, let's say a check came in today, you started accruing day one, probably mid-October, for call it 50-ish days.
We're in late August right now, if you're on recording.
Thank you. See the payment. That said, in terms of liquidity, it is locked up. I would share that this is not like a publicly traded REIT or something. So that's just something to consider. And once again, if you do have the liberty of having different buckets of money, so even if you're 55 and 5 years till your potential to take out without early withdrawal, a solo 401k and SDIRA could be a good move. It's kind of how we are at with BV. There are different unique situations that I can share, offline, and please reach out with maybe some smaller deals, different sponsors of how that can play out.
Right. And, I think for a newer real estate investor, Dan can obviously go over this privately and explain, but something I struggled with is like, well, I'm investing in equity or debt. There's some of those are kind of presented to the investor and then, the manager of the fund. So can you talk about when you're entering some of these funds, you're investing in the equity or the debt or both?
Yeah, great question. So I think you look to see what the offering is. What we've shared today has been, I'll call it a single offering within each. So that said, many other folks out there, they have, I'll call it the A, B, and C share. And, A is, hey, I put in $1 million, so I get 8% pref. C is, I put in 50K and I get 6%.
Okay.
For example, what we are seeing now, especially as the debt environment's changing, some folks say, you know what, kind of like the deal, but I don't want to be in that last tranche. So you're becoming in this pref equity sort of, which is going to be, you have your bank debt, let's call it, your pref, and then you have your common. Okay. So folks want to stay in here. Some folks might say, listen, I know this could be a 16 to 22 IRR, but I just want the 10%. I feel warm and fuzzy on this. Yep. And you're going to pay me the 10% on an ongoing basis. So let's call this in a separate example, the Class A, and the Class B is strictly going to be on the back. And it's funny, one of my early investments, that's exactly what it was. I had the choice for Class A, which kicked out the distributions, or Class B, which paid me at the end. So, for no good reason, I split it down the middle. I think I put 50 in one, 50 in the other. But it's something I would definitely read the fine print also to see if you're getting effectively a share of the profitability or strictly getting back your investment. So there's some stuff in terminology. That's why I would just go back to the basic question. Here's $100. Here's some scenarios how it can play out in the market. What happens to my $100? Yeah,
and feel free, like if you're talking with Dan or anyone else in real estate, always feel free, if you are overwhelmed, to ask them to wheel it back to that $100 example, and that will help you explain it in plain English. And again, asking is like the devil's advocate for a super new real estate investor. And when you say the back end, is that where like an opportunity would close, or maybe some property is sold?
Yeah, great question. So usually it's a capital event, as I call it. You hear back end, sometimes people hear upside. That's kind of a common term for, yes, there's an equity event here. It could be a refi, it could be a hard sale, etc.
Yeah, so when you're judging that as an investor, like what's the right goal for me? Some people are trying to lean more towards the yield because that's like a bond replacement to them. I was getting this % through my bonds. I see real estate can get me more. Others, they look at the IRA side and they say, hey, this can really be a capital gain home run, which would be great, but a huge tax bill. So they're thinking a lot more towards the back end of the deal, like a capital event. If the property gets sold and then the fund, big capital gets through the fund, really changes the whole structure of the fund. Okay, so there's no other questions. I'm just going to run through, for the benefit of the recording and anyone else listening, the differences between our pricing and then a Rocket Dollar account direct custody IRA versus IRA LLC. Sure. All right. Okay. So here you have the Rocket Dollar pricing on the left. We try to have really flat fee pricing. As Dan said, no AUM fees at BV Capital, no AUM fees at Rocket Dollar. We are not a financial advisor. So the silver and the gold on the left, that's really like a membership level and pricing for your amount of service. Our silver customers, that's a basic account. It's going to get you a limited number of investments. You can do whatever you want to do with it. It's mostly email support, or you can schedule a call with our team. Our gold account is a white glove service. If you would like to pick up the phone and basically call Rocket Dollar at any time during business hours. And here are some of the features that it has. Accelerated onboarding, complimentary wires for a year, and you get extra features with our direct custody of our IRA LLC. Okay, so quickly, as we get to the end of the hour here, what is the difference between a direct custody IRA or an IRA with an LLC, also known as checkbook or bank control? So with a direct custody IRA, This is more similar to what people are using at TD Ameritrade or Fidelity. For a new investor, this is going to feel really familiar, just with one extra step or two, no weird curveballs that you really haven't dealt with. So the catch is, to approve an asset, the custodian that we work with must approve that asset before that comes on the platform. So like, we have a relationship with BV, they can shoot us over the documents if they have a new deal and make sure they get approved. So you don't really have to worry about that. If you brought something, say bring your own deal, that Rocket Dollar and our custody partner is not familiar with, has never heard of, our custodian partner would have to review those documents. If this is an experienced investment firm, this should be fine and this should be really easy. If this is like maybe a mom and pop real estate outfit, like let's say, they're great real estate investors, but they're not good at paperwork, they don't have a corporate lawyer, they do rental properties, and you want to go in with the mom and pop on their deal. Some people will go with the IRA LLC because it has an IRA, an LLC, and a bank account in it. And what makes this so easy for some real estate investors is if they see a deal pop up at the last moment or very quickly, or maybe it's that mom and pop, their paperwork is not organized, but they're calling you and say, hey, this deal is closing in a week. I would love to have you in, but we don't have time for paperwork. We got to finish paperwork in 5 minutes. With the IRA LLC, as the manager of the LLC, inside of your IRA, you can send out a wire, a check, or an ACH to get in that deal immediately. Now, why do some people, people say like, that's great, why would I do the direct custody then? If you're just looking to be hands-off, if you're looking to just do a couple investments, if your aunt or uncle or someone that's not super financially savvy is trying to jump in on this for the first time, the IRA LLC can sometimes be really intimidating. And here at Rocket Dollar, we launched a direct custody product because people have been demanding it. And we don't want investors to be intimidated. We want them to be able to access these type of deals and not be left out at a great deal at BV or somewhere else because they can't figure out why they need this LLC, or they don't know, like they have to send their own wire. And they're like, Rocket Dollar is doing this. Why do I have to send a wire? So think, what's best for a particular person? It's up to you. I would say if your experience level is high in real estate, you can take the plunge and we'll help you learn with the IRA LLC. Just give us a call. We'll explain everything you need to know about it. If you're looking for a little bit of guardrails or you're looking for kind of a hands-off experience, if you're looking for a really great tech integrated experience, we're going to be able to keep releasing more and better updates for the direct custody IRA. And we'll still release ones for the IRA LLC. There will always be a little bit disconnected and independent because you have to send the money as the manager. Okay, and again, like to just check the chat here. If we have any last questions?
We're good.
I think we're good. Dan, thank you for coming out
Awesome,
today.
Brendan. Great to be here.
All right. And we're going to make sure that's thank you, everyone.